Ever thought about when to take profit in a rising market? How about the fear of the market rising further after you have sold, yet worry about market getting overheated with an imminent correction on the horizon? If these are your worries in a rising market, you are in the right place. We are here to teach you how to utilize a protective collar to ease your worry. You will never invest the same way again once you learnt about the magic of a protective collar. Let's get started. Welcome to The Money Dove, a channel all about stocks, options, investing, and financial decisions to embark on a journey towards financial freedom. Be sure to like and subscribe. What is a protective collar? In essence, a protective collar is about selling a call option above the current market price and buying a put option below the current market price for your stocks or ETF. The put option you bought protects you from the downside in case of a sell-off, while the call option you sold helps to pay for the put option, but it also limits your upside. Before we dive deeper into this, here's a quick explanation of how options work. You can also check out our other video here on the basics of options. Buying a put option allows the buyer of the put option to sell the stocks or ETF at the strike price. So whenever the underlying stocks or ETF fell below the strike price of the put option, you would exercise it and sell your stocks or ETF at the strike price. Buying a call option allows the buyer of the call option to buy the stocks or ETF at the strike price. So whenever the underlying stocks or ETF goes above the strike price of the put, the buyer of the options would exercise the call option. As the seller of the call option, you have to sell the stock or ETF at the strike price then. Let's use the SPY, an ETF tracking the S&P 500 index, as an example. Market is at an all-time high, and you are afraid that a correction of 10% or more could be on the horizon. You want to buy a put option with half a year to expiry and 10% below the current price. However, you do not want to pay the premium for the protection or put option, so you look for a call option that you could sell to earn the same amount of premium. You found that selling a call option with half a year to expiry and 7% above the current price provides the same amount of premium. You understand that the S&P 500 returns 10% to 14% per annum in the last 10 to 20 years. Given that the S&P 500 is already at an all-time high, you totally do not mind taking profit and selling the SPY if it rises 7% in half a year. In the event that the SPY rallied by more than 7% in half a year, you sell your SPY shares at 7% above the price 6 months ago, taking profit. On the contrary, if SPY falls more than 10% within the 6 months, you are protected and can sell your SPY shares at 10% below the price 6 months ago. There is another scenario where SPY falls within the next 6 months, but by less than 10%. Let's use an example where SPY fell 5% to 475 in 3 months' time. You assess that there were some headwinds in the previous month, but is confident that the situation will be improving. As a result, you decided that you no longer need any downside protection. Because SPY had fallen by 5% over the last 3 months, the value of the put option you own is now worth more than the call option you had sold. You decided to unwind the protective collar, selling away the put option and buying back the call option, collecting a small premium by doing so. In this scenario, you keep your SPY shares and manage to collect some premium, offsetting the paper losses on your SPY shares. Amazing, isn't it? Now, you might be wondering whether a strategy that limits your upside could be a silly strategy to deploy. The trick lies in choosing when to utilize this strategy and how much upside to limit. Without diving into the details or calculations, a general rule of thumb is to utilize the protective collar after a rally, setting your call option at a level where you would like to take profit anyway. And that's it for the quick guide on protective collar. Let us know in the comment section whether you would utilize the protective collar in your investment journey, and let us know what content you would like us to discuss next. Till next time, and good luck to your investment journey.